I got asked about using tight stops, and I think the thing to remember is that the premise of your trade is what determines your stop loss. So there are traders who are trading with wider stops, and there are traders who are trading with tighter stops, and they're not necessarily in the market for all of the same reasons. And I wanted to start off with an example, like bar six on Friday. So if you bought above bar six, what are your options for your stop? Well, you could just probably just put a stop directly below five. Why? Because it's a big high too, and if you're buying above six, one of the valid reasons to do so is you think that it's a high two on the open and that this is the low of the day. You know, coming into the day, following a big bear trend day, there's a 75% chance that you're going to get 2 hours of sideways to up trading starting by the end of the second hour. So if you're buying above six, you can put a stop below six with the argument that this is a possible low of the day, and we're going to get at least 2 hours of sideways to up trading. What's your trade off if you have a tight stop here? Well, your probability isn't all that great of that happening. So some traders will take the trade and just put the stop directly below. And other traders will say, yeah, well, I don't really want to take this trade with, a 40%, 30% probability. What I'd rather do is be willing to scale in. And so what those traders will do, maybe they'll put a stop and measure move down of bar six. So what they'll do is they'll buy above bar six and they'll buy more. I don't know, by the way, if this is the best place to do this type of thing, but these are all, whenever I'm giving wide stop examples, I'll start with the fact I don't usually really trade with super wide stops. So this is more just conceptual ideas. So if you're buying above six and you want to have a wide stop because you don't really want to, or you want to have a higher probability, you could put a stop, a measured move down at bar six. And if you're doing that, you're betting it's not a bear trend day, right? And you're betting it's a trading range day. And it's a trading range day or a bull trend day. And you know that one of two things is likely to happen. Either you buy above six and it is the low of the day and you get the rally like we did here and you make money, or you buy above six and you're willing to buy more as it goes to where those traders with the tight stop, where they get stopped out, you buy more there. Why? Because the reality is there's probably more buyers below six than there are sellers. It's still reasonable to put a stop below bar six if you bought above it, but other traders, like I said, they want higher probability. So they're buying here and they're adding on here with the premise that the market is probably going to at least come back to the bar six high before we get all the way down here. So they're betting on a trading range open rather than taking a bet that this is more likely the low of the day. And if you're doing that, I think that tight stops, you have to be able to make quicker decisions. Wider stops give you more time to make decisions, but the decisions become a lot tougher. So if you're buying above six, betting it's the low of the day, you're not as concerned with your follow through. You want to see good follow through, but you know that if it goes a little bit sideways first, it's okay and your premise is still valid. But instead, you got really good follow through here, which is obviously what the bulls wanted. The trade off for buying here and scaling in is your position size is not going to be as large. So the trader who bought above here and is willing to scale in probably has a smaller position size than the trader who bought here and just put a stop below here. But either way, you can trade with the higher probability, but you have bigger risk, or you can trade with the lower probability, but you have better. Sorry, you have better risk reward, right? So the traders have big risk, and that kind of determines whether it's a swing or a scalp. You can just buy above six for a swing if you want. It's a reasonable swing trade, and you're hoping it's the low of the day, and you're probably not going to be right. Right? You're most likely going to lose the 5 points that you're risking. But if you are correct, I don't know, maybe you make 25, maybe you could even have made almost 30 points on this trade. So you don't have to be right all that often for it to be a profitable trade. And on the 60 to 70% of the time you're wrong here, the bulls who scale in are probably going to be able to make money maybe 60% of that time. So maybe the traders buying above here and being willing to scale in lower are going to be able to make a scalp on their second entry and break even on their first entry like 70% of the time, whereas you're only going to win 30 to 40% of the time. So your stop is based on whether you're swinging or scalping and the overall premise of your trade. So it's not ever as easy as saying, when do I use a tight stop? When do I use a wide stop? It's dependent on what it is that you're trying to do. So I have basically a couple of examples more that I'm going to show that have that sort of thing. I think that another good example would be bar 16 on this day. If you're buying above bar 16, what is your premise? Well, you know that we got three pushes up, 1, 2, 3, or you could say 1, 2, 3 parabolic wedge, and you're betting on a breakout above the parabolic wedge and some sort of measured move up, maybe to here, which is about what we got. If you're buying above 16, you're probably just putting a stop below 16. I don't really think it's great to put a stop all the way down here. That's just really hard to look to scale in. I think for traders, a lot of these trades I'm going to show, like over here, I'm going to talk about a little bit how there are probably some algorithms that didn't get out in here and then they scaled in up here, and then they exit as the market comes back down. But the reality is as a individual trader, you don't want to be scaling in a bunch of times. You want to be scaling in once, maybe twice, and then getting out of your trade. It's not fun to sit through extremely deep pullbacks that pull way, way back and you have to continue to scale in. Most traders can't do that. So if you're buying above 16, what's your premise? Well, your premise is that we're going to break out above this wedge and we're going to get a measured move up from here to here. Good for the bulls. I don't know, maybe, Al generally says when you break above a wedge, 50-50 chance that the breakout's going to fail and get a reversal, and 50-50 chance it's going to succeed. So if you're buying above 16, you're hoping first target is the 12 high and you're trying to get a breakout above that. So let's take a different, let's pretend 17 wasn't your follow through. 17, let's say it was basically a doji bar, like a minimum follow through type of bar. Well, that changes the entire premise of what you're trying to do, because now the odds of your breakout have gone down. You wanted to see a good follow through bar buying above 16, and you wanted to see the market break strongly above this high and close above the high of the wedge, which is exactly what it did, which was good for the bulls. But if you instead got a doji bar, you might get traders thinking, well, 16 is a pretty big bar and the risk is pretty large, so I don't really want to be in this trade anymore. And then they would just exit the trade. And that's why sometimes if you're watching the market long enough, you'll see that if you get a bar like bar 16 sometimes and then a doji follow through bar, you'll start to feel nervous if you're in the trade. And the reason you're feeling nervous is because all the other traders are feeling nervous and they're going to panic out of their trade. And that's what would cause a big bar like this. It's kind of the exact same thing that happened a couple bars over here. This is not a great buy the close rally. So the traders buying up here, they're probably not willing to scale in. They're probably just going to get out really quickly if the market starts to go against them. There are some traders that they see 13, they know it's a minor reversal, so they'll buy more below 13, add on a couple points lower, add more a couple points lower. But those traders have stops way down here. So they have really big risk, but they know that it's very likely that they're going to win considering how tight this channel up was. So you could do that, but I think that's a more difficult trade. Instead, what a lot of traders do is, they see 10, they say, okay, good bull bar. Maybe we're going to go close this gap with the 47 low. And they see 11, they say, okay, well, that's not really a great follow through bar, but it's still enough follow through for me to be convinced we're going here. And then they see 12 and they think, well, why haven't we gotten to the magnet yet? We're really close. We should have just gotten vacuumed up. And then you get a doji bar on 13. And when they see 13, their premise that we're going to go here isn't as valid as it was, because those traders were expecting a vacuum test. If you were buying, you were expecting high probability that we just get a quick bounce and you make a scalp. But instead, you're near the magnet and you get a doji bar, which is a sign of slowing momentum. And it means the buy the close rally is probably about to come to an end. So when those traders see that, they just dump at the market, right? Instead of holding on to their trade and scaling in, most of those traders just flatten the trade. And, those traders had a lower probability of making money than the traders who were buying in here with a really wide stop. But it's they had to be faster than the traders who had a wide stop, but they also don't have to make the difficult decisions, because the question you have to ask yourself if you're trading with wide stops is, are you going to see 14 and 15 with a stop down here and your risk is really big? And are you going to be able to buy more down here when it's trading down here? Most traders can't do that. So anyways, back to over here, the traders who buy above 15, their premise is that we're going to get a breakout above the wedge, and it happens on 17. So some traders, they have a similar premise, and they want the breakout to succeed. They waited for 17 because they wanted higher probability. The trade-off is the risk, 16, 17, is now a bit bigger. So instead of just risking, 7 points, they're now risking more like 10 or 11 points. But they got the breakout that they wanted, so their probability of success is better than the traders who bought above 15. All of those trader stops are probably below 16. It's probably a reasonable swing trade or scalp. I think it's more of a swing trade. I just mentally see more swing trades than I do scalps because I'm, a swing trader. But the traders buying up here, they can probably do it for a scalp because high probability that we're going to get at least a small second leg up. So some traders will buy here and they just want to make a couple points. And, what they're doing is they think that if the breakout fails, they're going to be able to scale in and we're going to at least get back to this price. But I think most traders buying up here are looking for the measured move up. A different example of something that would not be a swing trade is bar 30 on this day. You can see it's a trading range day, right? We had big down, and then we had a decent rally up. The rally up is a parabolic wedge, 20, 26, and 30. So parabolic wedge, what does parabolic wedge mean? It means probably two legs sideways to down. So you can sell below 30 and 60% chance you're going to make money. And, people say that, and you think, well, there's no way it's 60%. We're in a tight bull channel. But just because there's a 60% chance you're going to make money does not mean there's a 60% chance you're going to make a swing. Selling below 30, you have a 60% chance of getting a second leg sideways to down. So when you see 31, I think a lot of the traders who sold below 30 see 31 as the pullback, and they're expecting a second leg sideways to down, which we got on 32 and 33. But once we get 32 and 33, the bears have accomplished their goal. You have to realize that, right? So if you sold 30, you can't, you probably have to scalp out during 33 with, 5 points is a reasonable scalp size on this day. You can't just sit in the trade and hope, because at that point, your premise doesn't really make any sense anymore. If you sold 30, again, I'll just say it again, but you sold 30 parabolic wedge, you wanted two legs sideways to down, you got it. Now what? Now what's your premise if you're still short? If you're sitting there on the close of 33, your premise from 30 is no longer valid. So you have to think up some sort of new premise, and you're probably gonna have a tough time, finding a lot of logical reasons. Reality is, it just seems like we're testing the bottom of the channel, the 22 low. We might go a little bit lower. We do have consecutive bear bars, 32, 33, and that's probably enough for a second leg sideways down, but we could pull back all the way to the sell climax high, the 32 high. So it's really not all that great to be holding short down here. Instead, what you should probably do is just find a way to scalp out. Okay, so what about 34, 35, 36? Those were reasonable buys. Why? Well, traders taking those buys were betting we were going to get a breakout above the parabolic wedge. 1, 2, 3. We got the two legs sideways to down. And the traders buying up here, their premise is we're going to get a breakout above the parabolic wedge. We had a failed breakout below the 18-bar range earlier today, and so they want a measured move up of the parabolic wedge to probably near a new high of the day, I would imagine. So a little bit above it. So the traders buying here, what do they want to see? Well, they need to see good follow through pretty quickly, because you need to think about the fact, you need to think about your premise, right? If your premise is that we're going to get a breakout above the wedge, you want to at least get the breakout to the new high before you get any sort of pullback. It's the same thing over here. If we had started to go sideways here, traders were thinking, we might not even get the breakout, let alone have a successful breakout. So they'll start to look to exit. And that's exactly what happened over here. Some traders bought 34 aggressive, or others bought 35 consecutive bull bars, and some waited for 36. So at this point, we have 3 consecutive bull bars, and we're probably going a little bit higher. It's very likely that we're going to get a second leg sideways up. So some traders, they buy here, they have a stop down here, risk relatively big, which isn't all that great. You're risking 8 or 9 points. But if you're going for the swing trade, you're trying to make a lot more than that. So your premise is that we're going to get the breakout above, and then you see 37. And you see bar 37, and you think, well, that's not very good. I didn't want to see a bear bar closing near its low. Now this looks like it might be some sort of trend line break. Here's your trend line. And then you get the break, and then a lower high, potential major trend reversal. So traders think, I did not want to see bar 37 closing near its low here. I was hoping that instead we were going to get a bull bar. So they think that if we trade below 37, their premise might not be valid. And it doesn't mean the premise isn't valid, but what it, something to think about is, if it trades below 37 and your premise is still valid, what is going to happen? Your premise is we're going to get a breakout above the wedge, and you see 37. If we are going to get a breakout above the wedge, you are going to get a bull bar closing near its high. It's really unlikely that you're just going to get some sort of massive outside up bar that goes for the whole measured move. What's going to happen if we do end up getting that breakout is, and it trades below 37, is if the bulls exit and then we start to get a bull bar or two closing near its high, you can just re-enter because your premise becomes valid again. But I think when it trades below 37, a lot of traders exit because they're not as confident as they were when the trade started. So, and additionally, something that's interesting to look at, you can see we got a micro gap up on bar 38. Why? Well, because some traders did not want to take the trade with big risk. And so what they chose to do was take the trade with small risk. And you can see, I think it's 1, 2, 3, 4. I think it's these 5 bars. Let's see. 30, 1, 2, 3, 4, 5. Okay. So it's these 5 bars. So forget this one. It's these 5 bars on a 1 minute chart that are causing, that are creating that bar 39. And if you look at it, for the first 3 minutes, we stayed above the price where bulls would have exited. Why did we stay above the price? So for the first 3 minutes, this sell below 37 did not trigger. Why didn't it trigger? Well, bulls with a different premise were buying the close of bar 37. They knew that this was probably strong enough for a second leg sideways to up. They also know that the bulls who are long for any reason are going to exit below 37. So what they do is they buy the close of bar 37 and they just drop a stop directly below it. So what do those traders want? Well, they'd like to see the swing and, have only risk, basically a point, and they're, get the swing up and try to make 20 points. But they're also okay with just taking a scalp. So those traders have a bit of a different premise than the traders who bought earlier here. So when the first 3 minutes, what were those traders doing? Well, they were trying to drive the market up and get it up and over the wedge so that they could potentially get the swing up and make a lot more money. But instead, when we were stalling up here, they decided, this isn't doing what I want it to do, so I'm going to scalp out. And those traders, what they do is they scalp out. If you look, they were able to make exactly 2 points. So it's not a coincidence that, sorry, I had that wrong. They were able to make 1 point, I believe. I checked it earlier. Yeah, so they were able to make 1 point. So if they bought the close of this bar and then they were able to scalp out at high, they were able to make 1 point. So you have to be able to recognize that there's a swing opportunity and a scalp opportunity on a lot of bars on the chart, and your stop placement is going to be based off of what you're trying to do. And it's a similar thing over here, and your follow through, by the way. So if you're talking about the thing everyone wants to know is what kind of stop should I use and when should I get out? The stop you should use is based on your premise, and when should you get out is based on the follow through you need based on your premise. So the reason that, the way you start to figure out what kind of follow through you need is kind of just experience and looking at the market for a lot of years. But if you're selling, I'll give an example of, I'll give an example of what I was thinking. So I sold on Thursday bar 15, and I ended up exiting because I didn't like the way the bar was acting. It was a mistake, but a lot of traders, they sell bar 15, right? And they know that 14 was a big bull bar closing near its high. So 14 is probably a magnet later in the day. And if you're selling 15, you're also selling right on the moving average. It's a credible sell. It's a double top with bar 10, and you're selling hoping for a break below the neckline, bar 11, and a measured move down. But if you're selling below it, what do you need to see? Well, you're taking a lower probability sell because generally, when you have a big bull bar like 14, you're not going to race straight down against it. So you're taking a bit of a lower probability sell. And just as a baseline, if you're selling below 15 and you have a stop above 15, or I guess 10, 40% chance you get a break below the neckline and the measured move down. So just general rule of thumb, you see a double top, 40% chance you get a break below the neckline and measured move down. You're risking 8 points, trying to make 17 points or 18 points with a 40% probability. So it's a reasonable trade. But if you're going to sell below 15 and you get a bull bar closing your tie, let's say you get a bar like bar 6, it triggers, then you get a bull bar closing your tie. Well, how valid is your premise now? It's not really what you wanted to see. If you're selling below 15, you want the probability of your trade to increase as it goes because it's probably not going to work. So you need a good follow through bar. And that's what we got on bar 16. So traders sell the close of bar 16. They now have high probability. Some of them will put a stop. I think most traders who are selling here are putting a stop above 10, betting we're going lower. So they could sell. They sell the close 17. They sell the close 18. And then you see the bar 19. So what are you thinking when you see bar 19? Well, for individual traders, you just get out. You just get out above 19 and you be done with the trade. But there are algorithms that, maybe they sold the close of 15, 16, 17, and 18. And they know that later in the day, it's very late, or tomorrow, or sometime in the near future, we're probably going to come back to the 18 close. How do they know that? Because it was a reasonable thing to do to sell the 18 close. And this is probably more of a trading range day than a bull trend day. So does this look like the start of a bull trend? You have to ask yourself, no, it looks like a leg in a trading range. So the bears who are selling down here are betting that any rally is also going to be a leg in a trading range. So what most traders do with the quote unquote tight stop above 15 would be just quick to get out and get out at the latest above 19. And what some algorithms would do with a wide stop, let's say they sold the close of all of these bars, and they might even have a stop above the high of the day. And what they're going to do is they're going to sell more when it gets to above 15. So they sell, and then they'll sell more up here, betting that we're going to get back down to this low at some point today and allow them to take profits. And so that's why these buy the close, sell the close bars become magnets, because some algorithms will take every single one and scale in. Like it's not a good thing to do to buy above 62, but you're really deep in a bear trend. And so a lot of bears know that they have a very high probability of making money if they're going to buy above 62 and use a really, really wide stop and be willing to scale in lower, betting it's going to get back to this price. And that's exactly what they did. I thought bar 51 on Thursday was another really good example of this. So this is it would be a limit order trade, but it makes a lot of sense. So what some traders will do is they see the breakout below the wedge. They think, okay, great, breakout below the wedge. We're probably going at least a little bit lower. But 49 and 50 is big risk. Some traders don't want to risk that much. They know the probability is relatively high, but 50 is a bit climactic. So they instead look to sell a 50% pullback. Some traders just sell below 50 and put a stop up here, and that's a totally fine thing to do too. They still have a high probability of 60% chance we get a measured move down. Reasonable thing to do. Any trader buying below this knows, well, first off, don't. But there are always algorithms that are willing to buy below it. And what are they betting? Well, they're betting that this is all just a leg in a trading range, and that maybe we have a wedge, 6, 18, 50, and that this is going to turn into a bull trap, and we're going to get a reversal up. Obviously, it's lower probability that that's going to happen. It's not a very good thing to do, but there are algorithms that'll do it. And if you look at bar 51, well, if you look at a 1 minute chart on bar 51, I won't go into it because I've already looked at it. But in the first minute of the bar, it was around the 50% pullback. So traders who are selling the 50% pullback, what's their premise? Well, their premise is that this is strong enough for a second leg down, and they know that there's 4 minutes left in the bar. So they have a lot of time. And it's unlikely that this bar is just going to rally and it's going to be a 30-point bar and, they're going to get stopped out. So they can probably sell the 50% pullback with a stop above here, and they have a decently high probability of making money. Why? In the next 4 minutes, the market's probably going to try and test back down. And if 51 instead is a small bull bar, so it has a small bull body, a lot of the bears who were hoping that 51 was going to be a big bear bar like it was, will just scalp out and will probably start a bounce. But instead, we get a big bear bar closing near its low. So now their premise has changed from I might scalp out to, well, now this could be a good swing trade. So they'll hold and they'll potentially sell more. So the stop is probably up here for either one of those trades, selling directly below or selling the pullback. But if you're selling directly below, sometimes the market's just going to continue straight down and race down. And the traders who are looking to sell the pullback won't get filled for those trades. So they'll miss out on the money by not selling here. But the times that they do get filled, they have a better probability of making a scalp. And sometimes they'll get lucky and get the swing. So if you're looking to sell the pullback here, you're not going to make money as often as the traders who sell below here. But when you do make money, you'll probably make a good amount. I don't know if I worded that correctly. But I thought that another good example was on May 21st, 2024. So look at bar 64. If you're buying, you're thinking, well, it's probably a wedge. 55, 60, 63, or, you could say 55, or sorry, I meant 57, I don't know, 61, 64, something like that. But there's some sort of wedge in here for everybody, regardless of how you want to count it. So you can buy above 64, but what are you thinking? Well, it's probably more of a minor reversal because this is a relatively tight channel down. So if you're buying above 64, you're probably going to get a few legs sideways to up. And some traders, they buy above 64. They have a wide stop, maybe all the way below bar 47. They're willing to scale in below bar 64 or 63. No, betting that, something that's reasonable is the bar 50 low is the most, it's a buy climax low. So there's probably going to be buyers around the bar 50 low if we get there. And additionally, the bar 47 high, if we get to that high, bears who sold above that and scaled in are expecting to be able to make money. And honestly, I'm curious. Okay, we didn't end up. We found a little bit of support over here, but there's the traders who are selling above here. Some algorithms will just keep scaling in and relentlessly, and you end up getting back to it at some point. But my overall point being, traders who buy above here with a wide stop, they're just betting against the bear trend. So they're betting that this is all going to be a leg in a trading range. So even if we go a bit lower, they can buy more, and we're going to get back to the 64 high. Other traders, lower probability, will buy above 64 and put a stop below 63. but they know it's a minor reversal and they know we're probably going to go more sideways first. Why are we going to go more sideways first? Because we had a tight channel down. So if you're buying here, you know we're probably not going to rally straight up because the channel down was relatively tight. And that's kind of the difference between, it's still consecutive bear bars here, which is disappointing, the same way that you get consecutive bear bars here and it's disappointing, but you're expecting this to rally straight up because it's following a tight bull channel. And your risk is a little bit big here. So you need this breakout above the wedge to go relatively quickly. Versus over here, where was it? Well, let's say over here, it's probably more of a minor reversal rather than a breakout above something. And with the tight channel down, we might go sideways first. So if you're buying above 64, you can't be surprised when you see 65 and we go sideways 65, 66, 67 before we get the breakout. Some traders will wait for the breakout 68 and you get the outside pattern and the big breakout above. And I had one other example I wanted to show from May 16th, which I thought was interesting. So I thought 35 was a really great example. It is a wedge, yes, but look how tight down this channel is. It's really tight. And you have to ask yourself at a certain point, if this question doesn't resonate with you, it's fine because you just need to watch the market more, and that's the experience. The key to 99% of this whole thing is just experience. But if you're buying above 35, do you really think it's just going to race straight up? How often is that really going to happen? Really unusual, almost never. So there are two ways to manage the trade, and it depends on your premise. If your premise is we're going to race straight up, it's probably not going to happen. And if it is going to happen, it's going to happen really quickly. We're going to start to race up almost immediately. So what do those traders do? They buy, and in the first 20 to 30 seconds, it doesn't rally straight up, and then they just flatten the trade. Those traders have a low probability of success, but their risk isn't very big because most of the time they're just going to get out around break even. And the times they do make money, occasionally they'll get trapped and lose money, but the times they do make money, they should make a good amount. Most traders, what they'll do is they'll buy above 35. They'll put a stop, maybe a measured move down to 35, and they'll buy more below 35, betting that we're gonna test. If we test below here, they're going to be able to buy more. And since 35 was a reasonable buy in a trading range day, we're going to get back to that entry price. But it's not a swing trade; it's a scalp. So they know that buying above here and buying more below, they're probably going to make money. But the other thing that you have to realize is though they're probably going to make money most of the time, sometimes they're going to lose. And when they lose, they're going to lose a decent chunk, a couple trades worth of their win. But it's okay because overall you're going to make money enough of the time that it's going to cancel out your losers and then some. So if you look down at a trade like 58, it's a wedge, 1, 2, 3. And after a couple of cycles, you could argue consecutive sell climaxes. And if you're buying above 58, what's your premise? Well, I thought the premise buying above 58 is it's a trading range day. It's a simple premise, but if it's a trading range day, then the bear should exit here and it's a wedge. So we should get at least 2 legs sideways to up. And we'll probably test the open of the day because the open of the day is always a magnet on trading range days. So some traders buy above 58, put a stop below 58. That's the lower probability way to do it. Other traders, again, still with the premise that it's a trading range day, can buy above 58 and be willing to scale in lower. I thought that buying above here, the problem with buying with a tight stop here is you're buying in the middle of a trading range. But you're buying so low here that it's probably okay to just put a stop below it because if it's going to rally, it's probably you're just going to get a good bounce. But it's definitely okay to, I think, scale in below that bar as well if you want to. But again, if you're doing things in the middle of a trading range, you have to be careful because you're probably going to get bad follow through. So in trading ranges, the key is to look for a small bar at the top to sell or a small bar at the bottom to buy. And you get that small bar at the bottom, I think, on 58, and it's a reasonable buy, betting we at least get back to the open of the day and potentially even the 54 close, the pair of consecutive bull bars. So the traders who took the buy, the buy was down here. That's why the buy is not up here or in here because this isn't a bull trend. You have to keep that in mind. It's a quote unquote bull trend because we're going up, but it's really just a leg in a trading range. And if it's at a trading range, it's a third leg up. So it's 1, pullback, 2, pullback, 3. So if you're trading 65, 66, you're trading a third leg up in a trading range. And what's your premise? Your premise has to be that it's going to be this is going to turn into a big bull trend. And you have to ask yourself at a certain point, what are the odds that buying above 65, I'm going to get a big bull trend out of this? Not really all that good. So the buy is not up there. That's the profit taking area after you've made, 10-ish points, or I don't think they quite made 10 points. Yeah, not 10 points, sorry. But after you've gotten the move back to the open of the day or the 54 close or something along those lines. So the buy was down here. The buy is not up here. So I think, to conclude, the size of your stop is what's going to determine your probability. And you need to use the premise of your trade to determine your stop placement. And also importantly, you need to have follow through visualized in your mind before you take the trade and what you're going to do depending on the follow through you get. You got to trade in a proactive way rather than a reactive way. Trading is always reactive because you're reacting to what the stock market's doing. But once, when you take the buy above 58, you have to have a visual for, okay, if I get a disappointing follow through bar 59, what am I going to do? If I get a big bull bar 59, what am I going to do? If it goes outside down, what am I going to do? So you got to be thinking about that throughout the bar. And as the bar is forming, it'll give you a better and better idea of what it's going to look like. And you have to think about how the premise of your trade changes, the probability of your trade changes, and how your management changes accordingly, depending on those factors. So I don't know. I hope